We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
There's a place where the gold runs deep. And when you strike big. Meet Nevada's fastest growing mineral claim holder in the heart of elephant country. Visit nevadaking.ca to follow the story.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Nicholas Mertin. He's the founder of Digifox all-in-one crypto app and also the author of the DataDash cryptocurrency YouTube channel. Today's episode is all about Bitcoin and cryptocurrencies in general. I want to give everybody kind of an overview on these digital assets and just to learn more about them. And to expose our audience to a little bit more of the, let's say, emerging technology that is Bitcoin and cryptocurrencies in general. Nicholas, thanks for joining me today.
Tom, thanks for having me, man. It's a pleasure. I love the content you put out, man.
Thank you very much. Your content is super valuable as well in the crypto space, and I really appreciate being able to have the chat today. So why don't we start by why don't you explain to us a little bit about how you got into the finance world and where your interests came?
Yeah, absolutely. So to give like the kind of clean cut answer to like my story, I basically got involved in finance at a really young age, back probably about 9 years now in this case. I started learning about central bank monetary policy. I was going through the rabbit hole of understanding the global financial system, what happened in 2008. And I basically defined that finance was one of my key passions for my life. But before that, I really never had any serious passions. So I went down this rabbit hole, learned everything I could. And in fact, I actually figured out about Bitcoin as a brand back in 2011 when it was trading at $3. And I just didn't understand what it was. I thought it was a libertarian scam to get all of us who are eager to see some kind of new revolutionary technology fix the central banking issue, come into play and stuff. And I just thought, no, this couldn't be real. Well, anyways, years later, I kept investing in equity markets. I was trading commodities such as gold and silver. And lo and behold, I came across the development of Bitcoin getting back to its all-time highs at 1,100 in 2016 and 2017. And it was kind of my catalyst moment to go through, do some research on Bitcoin. I read the white paper, and it was like a light bulb flipped in my head. Basically, a switch had just turned on in this case. And I understood why Bitcoin was valuable as an asset. As someone who had that passion for commodities, as someone who had passion for trading in equities. And basically down the road, I was going through an online education program that inevitably led me towards creating my YouTube channel. And it was meant to originally, if you can tell by the name DataDash, wasn't meant to be a crypto channel, but I ended up actually doing a few videos on cryptocurrencies. People happened to like it. I noticed it, and I just kept on creating content, sharing what I was learning and what I could observe from my years of investing. And lo and behold, we grew one of the largest channels in cryptocurrency history. So it's been a true privilege. I've gotten to meet so many people, travel across the world, and just get to talk about this really interesting space that I think you and I emphasize, Tom, in this case, like we can barely keep up with, being people who work as content creators. There's so much going on.
Well, even just to be, I guess focused in each of our respective spaces, to try and pay attention to everything in the gold space, or for example, for you in the crypto space. Never mind if we're trying to pay attention to something else, it's almost impossible to keep up with. So that's why I encourage people, if they have any interest, to check out your channel. You do a couple of videos a week that really, hit some very granular points, and as well as point out the bigger picture for these projects as well. So why don't we start off kind of the discussion about Bitcoin by explaining what blockchain technology is, and then we'll get into some of the different let's say platforms that people can invest in.
Yeah, absolutely. So the way that I try to start by explaining Bitcoin is that a lot of people try to focus on how it technically works in this case. In this case, if you're worried about the security of Bitcoin or like how Bitcoin functions as a network, I would just say that it's been operating for the last 11 years, in this case since 2009 when it went actually live. And the thing is, Bitcoin has been operating soundly since then. The reason I tell people not to worry about the technology is starting off and explaining about Bitcoin's technology would be the same as if I was trying to explain how we're doing this video video call right now, or how we do messages over social media, how we use internet protocols like voice over internet protocol like we're using now. It's not a good place to start. Okay. The best place I always start in this case, Tom, is like focusing on what Bitcoin is. And I would say that Bitcoin is money that isn't issued by governments. It is a online digital currency that, much like a euro or dollars, has some form of value in the eyes of people, that people can exchange for goods or services, or they can hold to store their wealth, just like you would store money in a bank account or in an asset like gold. And the great thing about Bitcoin is that just like with most kind of economic analysis of things like gold, where unlike traditional currencies, you can print a large amount of them at central banks and you can dilute the currency supply. In this case, like gold, there's limitations to the overall supply of Bitcoin. In fact, it's programmatically designed to have a fixed finite supply. And this is why people compare it to gold, and if not, sometimes make the argument that it might be a bit better because it has the finite supply, not just a limited supply. We know that there will exactly be never more than 21 million Bitcoins in the world. And this kind of builds this interesting non-correlated asset that isn't tied to any nation state, any central bank, any specific economy. It's something that's a bit autonomous in nature and lives completely digitally. So I understand it's very difficult for some people to get a grasp of it in the sense that it's this digital money. But the major thing that I always emphasize is that whether it's world currency in this case, or other things that we exchange that are valuable online, a lot of what we value in this world is digital nowadays. It's non-tangible. And there are ways to make Bitcoin tangible in a sense, like traditional currency. But again, this is where it differs from something like a commodity like gold, where there can be some benefits, I think, to either of the different assets, which is why I'm long and supportive of both of them personally.
So why don't we go to move over to Ethereum, another one of the cryptocurrencies that I'm sure a lot of people have heard of, and in a way it is almost like the silver to Big Brother gold, right?
Exactly. Yeah, I think if you want to view it in an investment thesis, that can be a good kind of like quick pitch approach to Ethereum. I would say that as you go down the rabbit hole, I always recommend people do start with Bitcoin, because Bitcoin has a singular application so far, and that is it's an alternative store of value, or hedge in this case, for people's portfolios. They see it as an investment asset. And the same can be said for Ethereum. However, Ethereum has a lot of other utilities. What Ethereum brought to the equation that Bitcoin doesn't offer is the ability to develop smart contracts. And that's a very fancy technological term to basically allow for being able to create basically these autonomous pieces of software on the Ethereum network, where I can engage with them without trusting any middle party. So I can give a great example here. Ethereum not only allows you to do just like what you could do with Bitcoin, you could send ETH to one another. But let's say, for example, Tom, that I wanted to make a trade with you. Let's say that I wanted to trade Ethereum, in this case, for another token on top of the Ethereum network. Let's say we made Tom coin in this case, or Tom token. In this case, I'd be able to interact with you, in this case, through a smart contract. There's one of them that's very popular. It's known as Uniswap. And we'd be able to actually swap my Ether and your Tom tokens through the Uniswap protocol. We traditionally would have to go through some kind of bank, exchange, or broker, in this case, that would allow us to make that swap. But with Uniswap being an autonomous basically piece of software program on the Ethereum blockchain, we don't have to work with any counterparty. You don't have to trust Uniswap in this case to hold your funds or to process the trade. It functions the exact way it's intended to function. No one has central control to change how that contract operates. It functions exactly the way you expect it to when you engage with it. And this is something that's completely revolutionary comparative to traditional technologies. It's why I spend a lot of my time. I founded a startup that's focusing, in this case, Digifox, on making these smart contracts and all these applications easy to use, so people can be their own bank. They can interact with cryptocurrencies and digital assets in a simply streamlined way, and they don't have to trust as many counterparties or third parties with their money in this case.
Yeah, I think an important point that you bring up there is basically the trusting and the counterparty risk. Let's say, I've transacted many times through the SWIFT system, sent money overseas, whatever it's going to be, and it's a real clunky system. And to be able to use something like Ethereum or Bitcoin to transact in, where you can send currency, let's say, nearly instantly, and have it be verified by both parties, is something that is, let's say, the way that the digital world should be working, to be able to really streamline that process and be able to make those transactions quicker, easier, and cheaper. So when as we're talking about counterparty risk and stuff like that, Nick, I'd like to kind of highlight, let's say, some of the biggest risks to these currencies that you think that we need to address here.
Yeah, I mean, honestly, to be honest, Tom, as you mentioned, there's a lot of benefits to crypto in this case. Like, I use that analogy like I did earlier about explaining the tech. If I had to wait, 5 days to be able to send a crypto or a money transfer, in this case, it's already enough of a pain. But if I had to do that with my messages or my files on the web, it's something completely unheard of. People wouldn't accept it. So we've just been kind of expected to, kind of assume that banks are not going to have our better interest, and that, during this time period when we're using platforms like Swift, we're going to be dealing with these inefficiencies and just accepting them. Well, crypto is completely different in that sense, in the sense that you're not operating through any third parties unless you operate through a crypto exchange like Coinbase or Binance. In this case, you're doing things peer-to-peer. It's like I'm handing digital cash all the way across the world from me to you. In this case, where we can exchange value, we can do all types of things with value. For the risks that you meant, I'm not closed off to the idea that there are no risks whatsoever. There are some risks with cryptocurrencies, but it's not the ones that people tend to think about. The risks aren't things like the government stopping people from using crypto or censoring people from using crypto. We've seen that the vast majority of world governments have realized Ethereum and Bitcoin and realized that it's decentralized, it's permissionless, anyone can participate with these protocols, and they're censorship resistant. So there's little to no way where they can regulate or control people from being able to just access these networks in general. So I'd say that fear isn't one. There is a general fear, though, in the sense of smart contract risk, or, for example, certain bugs in certain types of programs on blockchain networks. So that usually is the general inherent problem. So I can give an example in this case. We talked about a program called Uniswap earlier, which allows you to basically and simply swap assets, one asset for another, in this case, just like you would in an exchange. Well, there are a lot of other smart contracts out there on the market that have had issues in regards to their code. And this usually happens when you don't have people, just like in general software practice, you always want to have people who audit the code, who understand how it works, make sure that there are no bugs or problems within the code that could lead to vulnerabilities or hacks. And there have been some within the cryptocurrency space. It's a big reason why at Digifox, we do a very high level filtering process. We make sure that the code for a lot of our providers are open sourced, that they've been critiqued, that they've had bug bounty programs where they actually get hackers and programmers to read the code and see what problems might there be within the code before they deploy the contract, things of that sort. So unless you take good practices into mind, there can be some risks with smart contracts, because some smart contracts hold funds. Some smart contracts will have it where you engage in send funds through them. It's going to basically depend on you at one point or another sending your funds or some kind of value through those contracts to get some other type of result, whether it's earning interest or making a swap or trade. So that's probably the biggest risk so far with something like Ethereum. Bitcoin doesn't have this, but it also is limited in its functionality. It's literally just, Bob sends one Bitcoin to Alice kind of transactions. It's just point A to point B, a value exchange, which is great, and also being able to hold the asset and hopefully have it accrue in value. But this is where Ethereum, when you start to add a bit more complexity and functionality, there can also be some issues as well.
So, Nick, I just want to go back to kind of the government. If they're going to start being threatened, and the central banks being threatened by cryptocurrencies and these decentralized exchanges. I saw a story today about there's very strong support across the G7 countries that they want to start regulating these digital currencies. So I want to kind of let's flush that out a little bit more and get your opinion on why the government, let's say, taxing or making it illegal to transact in these digital currencies, why that's not as big of a risk as you would think.
Yeah, absolutely. So I think you mentioned the answer right there, Tom, which is that in regards to the G7 and a lot of these major world authorities and kind of conglomerations of countries, the major focus point they have is making sure to have some decent regulation in place. So making sure that they're, for example, when it comes to things that might be deemed as security offerings, making sure that there was a big wave of ICOs that dealt with ownership of certain platforms or protocols. And in that case, that can be very well be deemed as a security in that case. So having regulation, proper universal regulation around initial coin offerings or ICOs, another form of raising capital. And the other thing as well, that's probably the biggest, is how to tax these, because I think, as we know, governments do like to make sure that they have some form of ability to tax. They do have the authority to tax, whether we like it or not. In this case, it's a major thing that I always emphasize is that in this case with crypto, you do owe taxes. I know, at least here in the United States. There are some other regions in the world where you have more favorable tax laws, but this is the major goal of these governments, these major G7 countries, is to sit down and say, what's going to be the tax framework? How do we tax gains made on crypto? Do we tax merchant-based transactions? There's a lot of, open questions that haven't been answered just yet. But in the United States, for example, you have to pay income tax and capital gains on a lot of these cryptocurrencies, so long as you have access to them in this case and you can exchange them, right? So that's the major goal in that case, is that these countries are going to try to come up with a uniform tax code, because some countries have been really behind or have had really misaligned tax programs that actually can lead people to be penalized and actually have to pay money that they don't own in this case. Like, they get charged for like over trading on cryptocurrencies. That's one example. I think in Poland they had that issue. But that's just one thing to keep in mind. It's understanding the tax laws. That could be seen as another risk as well in regards to crypto.
So one of the other things that I was thinking about this morning was the amount of energy that it takes to support these networks. So what happens if the energy consumption to power these networks starts to become like prohibitively expensive?
Mm-hmm. Absolutely. So the major thing here is that it's not so much about the cost that would be, I think, a threat or an issue, because miners, so long as they can operate at a profit, they will mine. And the way that they do this is that with each new set of transactions on the Bitcoin network that get confirmed, it's what's known as generating a new block on the chain. So this is where the term blockchain comes from. So imagine it like a ledger that's constantly updating and adding new sets of transactions. Each of those blocks, whoever discovers and creates that block gets a block reward of Bitcoin. So this allows them to get something that has monetary value that they can sell or keep, and basically hope to speculate and grow in value to cover those electricity costs. If it becomes unprofitable for a lot of miners to do this, they turn off their machines. So what we're seeing right now, the reason why there's increasing hash rate is that people are finding ways that make mining, in this case, or consumption of electricity, cheaper and cheaper. And usually in a lot of cases can be renewable, which is actually really good news in this case, compared to, burning, fossil fuels or a lot of kind of like energy intensive resources. The major thing I would say, though, is that a lot of these networks, these blockchain protocols, second largest one being Ethereum, as we talked about, they're actually making a transition now to proof of stake, which doesn't consume any electricity outside of just nodes running on their computer. This isn't anywhere near. It's a fraction of the energy consumption that you would find on a network like Bitcoin. And I think that you're going to see a lot more support either for proof of stake or other forms of consensus mechanisms. I'm really hopeful in the sense that I don't think proof of work in the long run is going to be the ultimate solution, but it's also going to be very difficult for the Bitcoin network to evolve and change that if it does choose to do so in the future.
So one of the other, I would say, risks that was brought up to me, Nick, was like as you were talking about auditing. So something that I've been thinking about is Tether. And can you explain that to people, what that is, and if you see any risks to, let's say, the price of and store of value of Bitcoin that is associated with Tether?
Yeah, absolutely. So I would say probably the biggest concern that people bring up to me frequently on the channel and just in the crypto space abroad is that what you're referring to in this case, Tom, just to clarify for some people who may not know, there's these coins called stable coins, and they're basically pegged to the dollar, in this case, 1-to-1. And in a lot of cases, there's a lot of different forms of stable coins. There are some that, like USDC, which is separate from USD Tether. There's another stable coin called USDC. It's issued by Coinbase and Circle, two of the most reputable companies in the crypto space. They have an audit, basically a 1-to-1 peg in this case of dollars in a bank account backing every new USDC token issued. It allows you to send dollars over the Ethereum network. There is USD Tether, which, according to my understanding and the documentation that's been available to me and what I've seen, is that for USD Tether, it's a stable coin that's backed 1-to-1 by other types of crypto assets. It could be dollars. It could be, in this case, other cryptocurrency holdings. In this case, making sure that there's some kind of reserve asset backing each new Tether issued. And then the third type of stablecoin is a crypto collateralized stablecoin, such as DAI. So it's spelled DAI. And it's backed, it's an Ethereum network stablecoin pegged to the dollar that for every amount of DAI created, there's a larger amount of Ethereum used as collateral to back up the creation of those stablecoins. And you can't move those Ethereum, they're locked in the contract. So it's a way where you can get stablecoins in the short term while also holding your reserve asset. So you can still benefit from the growth in price or possibly lose from holding the asset. And there is a potential risk of a margin call or liquidation event that sells off the Ethereum to cover for that DAI. But anyways, yeah, that's the general gist of it in that case. There's a lot of different stable coins, and the sense of the worries that some people have. I know there's some headlines that talk about Tether driving Bitcoin's price. There is no doubt that overall, when you're talking about issuing new stable coins or new liquidity to the space, I don't know. I don't care what stable coin it is. It's definitely going to bolster Bitcoin's price. And the reason why is because as you're issuing these these stable coins, there's probably one key purpose for them. And that's to buy crypto. Some of them are using stable coins for payments. That's one thing that we do. People can send USDC or any crypto through the Digifox wallet in this case from other crypto wallets, peer-to-peer, without any middleman in the process. But at the same time, with something like Tether in this case, a lot of people are curious if in this case that major stable coins are starting to break away from the actual either collateral or assets under management that back it up to that peg. I would say, I'm not 100% certain. I think Tether so far has proven that it's one of the largest stable coins. They're founded by one of the parent companies is Bitfinex. They're a pretty well-known, reputable exchange. I would say in this case that I personally prefer USDC overall, because I think that Coinbase and Circle, being mainly based in the United States, they have a lot of regulatory restrictions that they have to meet to. So USDC has been really garnishing a lot of growth as a competitor possibly with Tether.
Awesome. So I'd like to move on from, let's say, some of the risks to going back to some of the let's say the pros for Bitcoin. And one of the things that you bring up that I thought was a great point is that right now in this, let's say, the early days of Bitcoin, you could say, it basically exists as a combination of a speculative asset as well as a store of value. So tell us a bit more about that and like your thoughts around that.
Yeah, so I know that, it's funny, Tom, like when people have built that correlation of the two terms, they're like, how can Bitcoin be both of those? That kind of sounds like an oxymoron or like they kind of contradict one another. Well, the reason why it could be both of those things is for two key reasons. So Bitcoin, in the sense of being a hedge, it can be a hedge because it's not really correlated to anything. It's not issued by any certain nation or government, similar to gold in this sense. That's why gold is really great. And along with it as well, it has the same fixed monetary supply, that you would find usually in an asset or commodity like gold, which again gives it the similar traits to precious metals. But the secondary aspect that gold really doesn't have right now is the speculative argument or the speculative benefit, where it has a lot more volatility and room to grow as an asset. And the reason why, and I don't think many people usually point to why that is, it's because of markets of scale. So if you take gold's total market cap, and that's found by taking the amount of ounces of gold out there in the market and multiplying it by the market price, you get basically a range. It depends on where the market price is right now, but I think right now it's around $12 to $13 trillion in gold that exists all throughout the world. That's a very, very large market capitalization of market. It's going to be very difficult to make the argument that gold as a market can go from 12 or 13 trillion to 24 to 26 trillion. That's going to take a lot of time, a lot of inflows of capital into the market, new buy side pressure on the markets. Whereas Bitcoin, on the other hand, as an asset right now at current prices is around $350 billion in market cap. So if you talk about Bitcoin doubling, it just needs to go to a $700 billion market cap. And this is why Bitcoin tends to have a bit more volatility. It's a new asset. It only started really trading back about 10 years ago. So in that manner, you're going to have a lot more volatility, a lot more room for growth, a lot more 5 to 10% increases in price on a day-to-day basis versus something like gold, which, for a big day for gold could be something like a 2 or 3% move in this case. So that's my key point. It's not me being bearish on gold. I love gold as an asset. I've been a big gold bug and silver bug for a long time. I always try to emphasize that to people. I follow a lot of the big guys like Peter Schiff and everything. They were my role models back in 2011. I was really interested in what they were doing. But at the same time, also Mike Maloney as well, great guy. But the thing is that at the same time, I love people like Mike who see that like this is a new respected asset class. It's not going away. And if the thing I always point to people is they'll say, oh, but isn't Bitcoin a bubble? It's like, yeah, that's the same thing people said to not only Bitcoin when it peaked out at 20K, now we're back to those all-time highs. It's the same thing they said to gold. Like they said gold was a bubble and it's going to fade off and stuff, but gold's back to its all-time highs. And I think that proves here that we've got something very clear here, a clear value proposition for both assets. And I'm excited to see how both grow over the next coming year in 2021 as central bank monetary policy is just getting more and more exciting. I think we're getting to the later chapters of this whole story, an experiment with the Fed and ECB and the Bank of Japan and the People's Bank of China. So it's going to be really exciting to see.
So before we get to, let's say, the macro factors that are driving this, one more point that I'd like to hit on, and I thought it was really interesting. You talk about expanding cycles and how you take that longer term perspective to looking at Bitcoin. So tell us a bit more about these expanding cycles, as you call them, and what that means.
Yeah, absolutely. So this is actually a great point, Tom. Like, and to just kind of showcase to people that I'm not some perma bull on Bitcoin. I understand that Bitcoin goes through cycles. It's going to have great bull markets and it's going to have great bear markets. One of the things that a lot of people don't tend to either understand or they don't want to accept because everyone wants the best outcome possible. Is that Bitcoin, just like any other asset, as it gets larger and larger, it has a more difficult time scaling out its valuation. So as we just talked about with gold, for gold to do a 100% move would be massive. It'd be massive because that's trillions of dollars of liquidity that's probably circulating in and out of those market pairs. And the same goes for Bitcoin in this case. As you go up through larger valuations, Bitcoin going to like a headline market cap of 2 to 3 trillion is going to be incredibly difficult. There's a lot of people in the crypto space who will tell you it's going to happen next year. It's going to happen in the next few months or next week. And I'm like, no, history tends to show us that there's actually a very predictable nature from the last 3 major cycles of how Bitcoin moves. It expands each cycle, in this case, from the bottom of the bear market, the brutal worst price possible, to the absolute new peak set a couple years later. It tends to be that we add around 11 to 13 weeks for each new cycle. And along with that the multiples of return from that absolute bottom to the absolute peak tend to actually be less than the previous cycle in the sense of percentage gains. It might be that the dollar value has gone to new all-time highs. It's, the dollar price gain is much more, but it's a matter of percentage gain. When I invest in Apple stock, I don't care if Apple stock goes up $20. I care if it goes up 20% in this case. That's the major goal for me, is to see the percentage increase. Mm-hmm. So I would say that's the biggest thing, is that we're seeing that as we look at these cycles, the overall market is taking a longer time to get to those new all-time highs to peak out and finish out the cycle, which gives us actually more time to accumulate and prepare for the cycle, which is good news. But along with that as well, the unfortunate news is that the multiples are not going to be what they were back in the day. You're not going to be able to see Bitcoin's price go from where it is right now at 20K to 200 million. It's just not going to happen. Just like how Bitcoin could have maybe gone from 10 cents to $1,000 in the past.
So, let's go back to some of the macro factors. One of the things that you understand very well, and I don't think that is necessarily always talked about in the crypto space, is this transfer of currency and value into these alternative asset classes. So why don't we start at these negative bond yields and what that really means for these markets, where we're trying to really capture the value of our fiat currencies at this point and store that value or even appreciate it if we can.
Yeah, I'm happy you brought up, Tom, because I think this is something that when they hear about bonds, they just kind of fall asleep and stuff, because bonds can seem really boring. But I can only emphasize one key point, and that is that bonds are the most important asset class to understand right now if you're invested in crypto or gold or silver. More than equities. So basically, for those who may not know, bonds are basically IOU notes from the government in this case to basically borrow capital to finance certain types of government expenditures. So in the U.S., we have U.S. Treasuries. In Germany, you have the bonds in this case, the German bonds, and you have different maturity times for these different government bonds where they'll be paid back in full after a certain period of time. It could be a couple months, it could be a year, 2 years, 10 years, 30 years. And it tends to be that as you go up the longer maturity dates, that the yields are higher in this case. You get a yield on it similar to how you get interest on a bank account. And those yields will vary as time progresses. Now, the yield itself is correlated very heavily with basically the main central bank rate. In the case of the United States, it's the federal funds rate. That's the rate that you always hear Jay Powell or the Fed chairman always talk about. And the important thing to realize is that we've been holding near, we had a period of time back over the last decade where we were starting to rise interest rates again, but we set in yet another lower high on interest rates and went right back down to where we were after 2008, and have been basically riding at rock bottom at 0.25%, just a fraction of a percentage away from 0%, if not what's known as negative interest rates. Now, a lot of people would say, negative interest rates, it just doesn't make sense. What does that mean? It literally means in this case that the Federal Reserve is looking at penalizing, in this case, the base capital in this case within the system. And in some eyes, it's seen as a way to encourage lending or get money into the system, when in reality, negative interest rates actually don't help. In fact, we found that higher interest rates are actually beneficial towards economic growth. It's one of the biggest misconceptions in monetary policy. But putting that aside, the effect that this is going to have on the bond market is that it's going to take yields on these bonds into negative territory. You are going to be penalized for holding IOUs from governments, whereas you, in any logical world, would be getting paid to be giving them your money to get debt. So again, we're in a bit of a twilight zone here, but this isn't just some kind of wacky world that, it's sunshine and rainbows and it's going to go on. We have to talk about how big this is. There are trillions of dollars, tens of trillions of dollars locked up in U.S. treasuries and European bonds and Japanese or Chinese bonds, all types of different countries across the world, Canada, Australia. There are about a dozen major Western countries that are developed that are about to enter into negative interest rate territory. And that's not even considering, in this case, bearing in mind the real negative yield, considering inflation, the depreciation of your currency. So right now, if we consider those two factors, we are about to step into a market of over $100 trillion of bonds across the globe, generally speaking, $100 trillion that are having real negative yield. And it's only going to become more real when people actually see the negative interest rate or the negative yield on their bonds. Mm-hmm. This has been the reality for Europe and Japan for some time. And there's already been this bubbling pressure to start reallocating to other asset classes. It's a very scary reality. So what's going to happen here? Where are people going to go to? Well, they could go into equities, sure. But the problem with equities is that equities are at all-time highs, whether you're talking about the United States or most major markets like the DAX for Germany and a lot of other places. They're either trending near all-time highs or are at all-time highs. So it's not a very favorable market to put your capital in. And you're also looking for something that's not correlated or something that's kind of seen as a guaranteed return. That's what bonds are useful for. There's something that's protectionary. And in this case, you could put it into gold and silver. I think that very clearly gold and silver are going to get a lot of benefit from this. They're time-tested assets and they're not tied to any government. And they don't pay you or charge you a negative yield in this case. They don't pay you on a yield, but they don't charge you. Same goes for Bitcoin in this case. But the great thing about Bitcoin as well, again, building on it as an asset, just like gold, it has a limited supply, but it differs in the sense that it has a finite supply. There is a fixed amount. In the case of gold, I think one concern we're going to have to really keep in mind, and I say this as a gold bug, is that there was just, for example, back a couple of weeks ago, there's a massive mine discovered for a gold mine in this case. And along with that as well, I think when you talk really futuristic, you talk about things like asteroid mining. I know it's far out. I don't want to try to pitch that that's going to be a problem here. All I can say, though, is we don't know the official tally for how much gold there is in the world. Mm-hmm. There's about a 1% to 2% inflation rate of new gold every year into the supply. So that's what I always emphasize with Bitcoin. We know in a fixed nature what the inflation rate is going to be for Bitcoin and eventually reaching towards our cap supply. So that'd be the big points I would draw in that case. But I think above all, Tom, as you brought up and stuff, this is going to be a massive set of ramifications for the macro perspective. And it's going to lead a lot of capital to outflow out of bond markets, but capital has to flow somewhere in most cases. So it's probably going to be going into either cash or it's going to be going into something that isn't penalizing it, something like gold, silver, or Bitcoin, or Ethereum and other digital assets.
Excellent. So for those that don't feel, let's say, safe enough to buy these cryptocurrencies individually, let's talk a little bit about the ETFs and ETNs for cryptos.
Yeah, absolutely. So one thing that's been getting a lot of traction as a recent, I've had family members and friends of mine use this as a way to get into crypto. There are these things known as exchange traded notes, which are not exactly like ETFs that maybe more people are familiar with, but they're similar in a sense. So ETNs are basically similar to an ETF in the sense that they're a share that represents some kind of ownership in something. In this case, there's one from a company called Grayscale, known as GBTC. And that has actual physical, or not physical, but real Bitcoin backing it in this case. So for every a share, there's an equivalent amount of Bitcoin backing it. And that gives it a sense of real value in that case. The problem with something like an ETN, though, is that it's restricted in the sense of the purchase amount. So you have to have a certain amount that you're buying. And along with that as well, there are fees associated. There are certain like periods of time as well that I think you have to engage in the asset. Long story short, there are a ton of restrictions. And the biggest restriction is not time in this case. It's that you have to be accredited. So you have to be of a certain net worth to engage with exchange traded notes like GBTC. Whereas on the other hand, with something like a Bitcoin ETF, which has been hyped up and discussed since back in the last bull market in 2017, when is the SEC going to finally approve a Bitcoin ETF? In this case, we're talking about a financial basically share. In this case, it's just like GBTC, but is open for anyone, and there are no minimums to ownership in most cases. So this is why an ETF is very big news comparative to an ETN, because it allows for people who have retirement portfolios, stock platforms in this case, who aren't accredited investors, basically anyone who makes less than $1 million every year, to be able to buy Bitcoin and have some fractional ownership. And just to kind of throw a ballpark figure out there, if you take pension fund markets right now, I think the value is just recently peaked around $50 trillion, if not close to it. If you talk about just getting 1% market share of people's portfolios, retirement accounts into Bitcoin or alternative assets and crypto, that's $500 billion of inflows into the market. And I always like to emphasize to people, it takes a fractional amount of liquidity as a per value of market cap increase to get valuations to where they get to. So like for, if maybe Bitcoin increased by $100 billion in valuation, it could really only take $10 to $15 billion to do that. So these valuation spikes, and when you hear people talk about Bitcoin going to 100K or 200K in the next cycle, as we predict, in this case, that's our general range in the next 2 years, it's not too crazy when you talk about just a fraction of that bond market flowing out, as we discussed earlier.
So one of the things that we were also discussing before the call here, Nick, was the secret wave of institutional investors possibly coming into this space. So let's discuss that and what that could mean for these markets as well.
Yeah, absolutely. I think that's a great point, Tom. So the one thing that, I think it's difficult to get a grasp on, and I don't blame people one bit, it took me a while to learn about this, is that a lot of what you see in the headlines is already in the works for months, if not a year. I think if anyone here, I don't know about you, Tom, and stuff, like if anyone's worked at like traditional companies or, have worked for like major corporates, that things generally move very, very slow. And it takes a lot of approval and a lot of everyone shaking hands and confirming things and working with the proper other third parties to make it happen. And what we've seen now is there's been a lot of major stories coming out in the last few months that have spiked Bitcoin's price. You have a company like MicroStrategy, an unsuspecting tech company, basically going all out, converting their entire balance sheet to Bitcoin. They just made another recent purchase as well, backing on that. You also have major companies, for example, like PayPal announcing that you can buy crypto through their application. You have major billionaires like Paul Tudor Jones, a lot of individuals coming out and saying like, yep, we have built positions in Bitcoin. Again, this includes major firms and brokerage platforms offering Bitcoin services. So the thing I always emphasize to people is that once we've seen that and even in the descriptions of these articles, you can see that they've been working on this for months. You have to think about, okay, what's going to come out 6 months from now? Like what's in the works right now? If these kind of companies are making these moves, major payment giants, financial institutions, when you see the amount of demand showcasing on Grayscale, who's created the GBTC exchange traded note, you can see the actual record online of how many shares they're having to issue and how much Bitcoin they're having to buy. What's it going to be like in 6 months? And that's the kind of, I think, a kind of FOMO or fear of missing out that's driving markets right now to these Bitcoin leading to all-time highs, Ethereum and a lot of other crypto assets starting to rebound at their biggest levels in the last 2 years since the bear market started. And I think that that's a really good telltale sign that, if you're getting into crypto now, it's not too late. This is like the beginning of the next wave here where, again, we could get to some of those higher valuations in the long run.
So that's one thing I'd also like to kind of touch on, Nick, if you wouldn't mind, is give us an idea for those that are interested right now of, where we are in this cycle and what kind of things that we need to take into consideration if people do want to really start getting into Bitcoin and other currencies right now.
Yeah, so I mean, honestly, above all, when it comes to Bitcoin, I know a lot of people think, I want to, again, back to that point earlier, they want to understand the tech and stuff. I recommend more than anything, you understand the value proposition of Bitcoin or cryptocurrencies like Ether as an asset class, what they can offer, what kind of value they can bring. And then afterwards, if you're interested, learn about the technology, understand the back end about how it works. It can definitely be beneficial for sure. But I would say that's a great place to start. One place as well that, again, I'm a bit biased in this case because it is my company and stuff. I recommend if you're just looking for like a place to simplify crypto, Digifox is definitely a platform for that. We just kind of basically not only try to tap every kind of service that you would need in the crypto space into one application, but outside of this, well, there's a lot of other great platforms. There's platforms like Coinbase, there's Binance US, PayPal that allows you to buy crypto. So there's so many ways where you can kind of get your feet wet, just putting in like something like 50 or $100. Of course, it's not financial advice at all, but like, just getting your feet wet, trying it out. It's the same as when I did stock trading. I wouldn't have put, my college fund or my retirement account into it. So in this case, I started off with about $800 or so, did 2 stock trades, lost some money on a penny stock trade. And then I made some on another stock to even out the losses. And it was a great learning lesson to, not do certain things. So I think, again, this is the kind of stuff that'd be like great to get started. In the sense of learning, I think, Tom, you've had some wonderful people on and stuff. I know that my channel and stuff, I think, could provide some good value. I have some educational content. And also, just looking up online, if any questions that you have, there's tons of content on YouTube. It's a library of resources out there.
Absolutely. So I think that's a pretty good place to wrap up here, Nick. Again, I encourage everybody that's interested in any of this to check out your channel, DataDash on YouTube, as well as the Digifox app. And if anybody has any questions, I'm happy to pass them on to Nick. My email is tom@palisadesradio.ca. Nick, is there anything else you'd like to add today?
No, Tom, I just want to say, man, it was a phenomenal conversation. I appreciate everyone listening in and you having me on, man. I think it's so cool to be here at the time we're at right now. It's a real blessing, and it's a real blessing to be on here, man. It was so great to get to chat.
Well, I really appreciate your time, Nick. And, my goal as our fans know is just to educate people and to try and bring different perspectives into trying to, let's say, weather the fiat currency storm that we can kind of see brewing here. Hopefully protect some of our assets and make it through. But I think education is where all of that starts. So, Nick, thanks very much for your time today.
Cheers, Tom. Thank you very much, man.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.